So in this video, I'll be answering some of the really great questions that I've been getting from you guys lately. We're gonna go through a handful of these to see if we can shed some light on the things you want to know the most. Starting with this question here from D. Fuller Lisa on YouTube, who says, I'm a complete beginner. I've never invested before. I'm using Fidelity. Do you think it's wise to put $10,000 in for my first time? I have it. I'm just scared. And this is a really great question. First and foremost, I totally understand the concern that comes with investing for the first time. Many people who've never invested in stocks before understand the stock market as this place where you put money into these things and the things go up and down for seemingly random reasons. And a lot of people are afraid to start investing because they maybe don't quite understand what it actually means to invest in stocks. In reality, investing in stocks is simply just investing in businesses like Coca-Cola, for example, which is one of the most legendary dividend stocks out there. And what many people don't realize is that at a very basic level, stock prices go up or down based on the fundamental performance of these businesses over time. With that said, though, $10,000 is a lot of money to invest at one time, especially if this is your first time investing at all. So I also understand your concern from that perspective. And so to calm some of that fear, a better approach might be to adopt a dollar cost averaging approach to investing instead of investing the entire $10,000 at once. With dollar cost averaging, you basically just invest a fixed amount at regular intervals. So for example, with $10,000, you can invest $1,000 a month for 10 months or $100 a week until you've invested the full amount. Really, you can break it up however you'd like to. It's totally preferential, but in general, spreading out your contributions over a period of time instead of putting it all in there at once is going to be a less stressful way to invest since you don't necessarily have to worry about timing the market perfectly. And another good thing is that you can always increase your contributions once you find your groove and once you feel confident about what you're doing. And now regarding what to invest in, I'm a huge proponent for investing in ETFs or exchange traded funds for brand new investors. ETFs let you invest in a diverse batch of stocks, which takes a lot of the guesswork out of investing and helps you build instant diversification. In general, ETFs can offer a fantastic hands-off approach to investing, which is why I think they're so perfect for brand new investors or really anyone who wants to automate the investing process and wants to make it as out of sight, out of mind as possible. And if you're looking for some good ETF options, I have a video linked in the pinned comment where I actually rank the top 10 dividend ETFs from best to worst. So definitely check that out. But anyway, guys, moving on to question number 2. This one comes from Christian Ornido over on YouTube, who asks, what investing applications do you use? And this is actually one of the most common questions I get. I'll list out all the different brokerages, portfolio trackers, and everything else that I use. Starting with the brokerages, for my main taxable account, I do my investing there through Charles Schwab. And this account I've had for a long time. Back in the day when I was like in my early teenage years, this was started for me as a custodian account by my parents. So this is just the account that I've always had. It's always been with Charles Schwab, which is why I still use them. It's the one I've always had. Back in the day, early on in my investing journey, there was a period of time where I did have an account on Robinhood. You can go back to my early videos and see that account. But at some point, I just decided there wasn't really much of a point to having 2 separate brokerage accounts. So I just decided to turn them all into one, transferred everything from Robinhood into Schwab, and that's just the account I've been rocking with since. And I really like using Schwab. One of my favorite things about these legacy brokerages like Charles Schwab or even like Fidelity is they have great customer service, which I think is important. If I'm going to be investing what hopefully someday will be a lot of money with these brokerages, if they're storing all this money for me, I want to be able to pick up the phone and talk to someone if I ever have any questions or if I ever have any issues. Just for my own peace of mind, that's something that I would like to have. And that's not something you get with some of these other newer brokerages like Robinhood or Webull. I don't think they have any over-the-phone customer service. And speaking personally, that's something that I think is really important. But anyway, interestingly enough, my other account, my Roth IRA, is over on M1 Finance. And my reasoning for going with this separate other brokerage for this account was because I wanted the Roth IRA to be completely automated. I wanted it to be totally hands-off, and M1 gives me all the functionality to be able to do that. All of my transfers every single week are automated. The investments into the 2 ETFs in that account are automated as well. I don't have to lift a finger to grow this account, which is exactly what I wanted, and that's why I went with M1 Finance for that. But then as far as like stock news and research, I mean, as you guys know, my go-to platform for all of that stuff is Seeking Alpha. I started using Seeking Alpha like right when I started started getting into investing a few years ago. It's the one that I've been going with from the very beginning. It's always been a really great platform to use. And I would say that the thing that I use Seeking Alpha for the most is the news and articles, as well as the transcripts. I really like having access to all the different articles and analyses. And when it comes to listening to the quarterly earnings calls or any other type of conferences, you can read the transcripts and listen to the audio right there within Seeking Alpha. And I've just found that to be very helpful. And in addition to that, another news research subscription that I have is actually with the Wall Street Journal. They have this deal if you go on their website for the first year. Every single week, it's only $1.50 to get access to the Wall Street Journal, Barron's, and Market Watch. I figured, for the first year, it's only $1.50 per week. That's really not too bad, so I went ahead and took advantage of that. And whether or not I'll keep the subscription after the year, I don't know. I'm honestly kind of on the fence about it. I still find myself reading Seeking Alpha a lot more than I do the Wall Street Journal or Barron's. I like Wall Street Journal and Barron's, but Seeking Alpha, more or less has everything I need. But anyway, as far as portfolio trackers go, you guys know that I have my free dividend portfolio tracking spreadsheet, which you can start using for free. You can download the spreadsheet for free. There is a link to it in the description of the video. But this is one of the main portfolio trackers that I use. I built this thing from scratch a few years ago, and over the years have been making improvements to it. Like I said, it's now in its 7th version. But in addition to that, outside of my spreadsheet, another portfolio tracker that I use is one called GetQuinn. And if you're looking for something with more features and functionality than a spreadsheet like the one I made, then GetQuinn is like one of the best platforms out there. This has one of the best looking interfaces I've ever seen, and it's a great tool for keeping track of all your portfolios, all your holdings, and all your dividend payments in one place. And you can automatically sync everything right here within the platform. And the cool thing is a lot of their core features are free to use as well. So there's no charge to sign up or start tracking your portfolio. And once again, there's a link to GetQuinn in the description of the video as well. But then outside of those few things, guys, the only other resource or tool that I use is this one we're looking at here. This is another one that I made. This is called the Investor's Almanac, and I use the Almanac as a database for all of my stock research. So every time I want to do a deep dive on a stock, or anytime I listen to a quarterly earnings call or anything like that, all of my notes go here into the Almanac, and I also use it to keep track of all my book notes. As you guys know, I'm a big reader, or at least I try to be, and anytime I come across a quote that sticks out to me, I'll log it in the Almanac, and then I'll write more about it, as we can see here, which I've found really helps solidify the information for me. But anyway, guys, those are the few things for me. If you guys want to check out the portfolio tracker or GetQuinn or Seeking Alpha, there's links to everything in the description of the video. But anyway, moving on to question number 3 now. This one comes from Michael Martin, who asks, do you only add to positions that are down, or do you dollar cost average into all stocks? So I don't exclusively add to positions that are down, but I will say just the majority of my contributions do end up going to positions where I can average down. I try to do that if I can. For example, over the last couple of months, I've been going really heavy into Starbucks and Johnson & Johnson, both of which are showing unrealized losses. Right now with Starbucks, I'm down about 10%, and with Johnson & Johnson, I'm down about 8.5%. And I'm really excited to buy these stocks while their share prices are down, because buying at that lower share price not only helps my investment dollars stretch farther, I can buy more shares with the same amount of money, but also doing so reduces my average cost per share, which helps me build overall stronger positions with these companies. With that said though, I don't limit myself to only buying stocks that are currently below my average cost per share. There are times where I'll buy above my average cost per share. They don't happen as often, but they do exist. And there's also times where I'll dollar cost average into positions regardless of the share price. A great example of this is Visa. I added to Visa every single week for multiple months, irrespective of the share price, because I was determined to build up that position. In fact, once I'm done adding to Starbucks and Johnson & Johnson, I'd like to get back to buying Visa. Ultimately, it just boils down to figuring out the most effective use of your capital. If you think that you own great companies, and those companies are currently priced lower than when you first bought them, then right now presents a fantastic opportunity to pick up even more shares. With that said though, there are plenty of worthwhile opportunities out there, and you don't necessarily have to be in the red to take advantage of them, especially when it comes to these great companies. Great companies will intrinsically increase in value over time. So in that instance, it can make sense to buy when they do go above your average cost per share, because intrinsically they're worth more. But anyway, moving on to question number 4 now. This one comes from Reginor Scott. I probably mispronounced that, and I apologize, but they say, suppose a person has considerably more invested in the market already, but the annual dividend is only $7,000. I want to preserve my savings for future generations while having dividends for bills. Where does one start to get this portfolio to bring in a more lucrative dividend income? And this is another great question. So when it comes to ramping up your dividend income, there are a few different levers you can pull. First and foremost, you might consider investing in higher yielding stocks, which will certainly give your dividend income an immediate boost. With that said though, I would not just go out and buy the highest yielding stocks or ETFs you can find, because many high yield investments are actually yield traps and end up reducing their dividends over time or completely eliminating them altogether. A great example of this is a company called Armor Residential REIT, ticker symbol ARR. As you can see, it has a crazy high 15% dividend yield, which is certainly tempting, but if you look at the 5-year dividend growth rate, it's declined by almost 20% on average every year for the last 5 years. We can see this played out on the dividend history chart here. Over the last 10 years, the dividend payments per share have pretty much done nothing but go down, which is the exact opposite of what you want to see. You want to see your dividend payments per share going up over time, and dividend growth stocks, which are on the complete opposite end of the dividend stock spectrum, will deliver that. So you definitely want to make sure you have some of those in your portfolio as well, especially if you are trying to save for future generations. These dividend growth stocks are companies that consistently and aggressively increase their dividend payments year after year. While their current dividend yield may not be as high as other investments, their ability to grow dividends at a rapid rate can lead to pretty insane increases in income over the long term. And the longer you do it, the better that gets. With that said though, dividend growth stocks definitely require a lot more time and certainly a lot more patience, because the full benefits of investing in these type of stocks will only materialize after a number of years. And I have no idea what your timeline is, but if you don't have a number of years and you need to start using some of that income to pay your bills like now, then it may potentially be worth considering, leaning more into higher yielding investments to give your income that immediate boost. But still, don't completely neglect dividend growth stocks. I think it's important to have a healthy balance between the two in your portfolio. So definitely keep that in mind, and also definitely be sure to avoid those yield traps like the ones I'm telling you about in this next video right over here. In this one, you'll learn about 5 high yield dividend stocks that many investors like to buy, but truth be told, they're terrible investments and you should avoid them at all costs. So click right over here to learn more about that, and I'll see you in the next one.